a weighted average cost of capital. We'll take up estimating its component parts, the market value weights, the cost of debt, and the cost of equity. We need data to make the estimates, and we have a pecking order preference for the data. Our preferred data is current market prices, because this is expectational data. Current market prices reflect the market's expectations for factors over a future period of time that establishes the current values and current prices of risky assets. If we don't have current market prices, our next preference is historical market prices. But when we use history to proxy for the future, we're assuming that nothing is going to change, that the future is going to be pretty much like the past. At the end of our pecking order is accounting data, knowing its strengths and its weaknesses when used in financial analysis. Market value weights. The market value weights and the weighted average cost of capital are based on market value mixes of debt and equity, not book values. Proportions of debt and equity should reflect the firm's target capital structure. The firm's financing policy will set the firm's long-term target for the overall mix of debt and equity in its capital structure. Target capital structures are proportions of debt and equity that managers assess will enhance firm value and enhance competitive advantage in terms of financing flexibility. Flexibility is needed to take advantage of profitable opportunities and to adjust to changes in the marketplace. Money in the firm is fungible. Some projects may be financed with debt, others with equity, but all financing is done with an eye on maintaining the overall target capital structure over the long run. So we impose the firm's target capital structure on all projects being considered by the firm, and assume that all projects will be financed at the firm's target capital structure. What kind of debt to include in capital structure? Leverage may be measured by long-term debt to equity or by total liabilities to equity, where total liabilities is current assets plus long-term debt. Now we're interested in the permanent level of debt, and short-term debt is often seasonal. Most financial analysts prefer to measure leverage using only long-term debt. The cost of debt and the weighted average cost of capital. Bond betas tend to be small and fairly homogeneous across bonds. They're close to zero. Any systematic risk of bonds is related to their interest rate risk. In practice, the cost of debt is estimated by the promised yield to maturity of the firm's outstanding debt, where the promised yield to maturity is that discount rate that equates the current price of the bond with its promised cash flow, its coupon payments, and its principal payment. Because it uses the current market price of the bond in its estimation, it incorporates the market's expectations regarding those promised cash flows. What if the firm has more than one class of bond outstanding? Well, then you calculate a weighted average cost of debt. Suppose the firm has two classes of bonds outstanding, senior bonds and subordinated bonds. The senior bonds have a yield to maturity of 8%, and the current market value is $150 million. The subordinated bonds have a yield to maturity of 9% and a current market value of $300 million. So the firm has $450 million of debt outstanding. We calculate a value-weighted average of our cost of debt. Our weight for the senior bonds is $150 million of senior bonds outstanding divided by $450 million of total debt outstanding. The weight for our subordinated bonds is $300 million of subordinated bonds outstanding divided by a total value of $450 million. Our estimate of the firm's cost of debt as a weighted average of its outstanding debt is 8.7%. We should also consider the corporate tax effects of debt financing and use an effective cost of debt in the weighted average cost of capital, where we multiply our cost of debt by 1 minus the corporate tax rate, and our after-tax cost of debt should be calculated using marginal or statutory tax rates. So given a cost of debt of 8.7% and a corporate tax rate of 35%, our effective after-tax cost of debt is 5.7%. The cost of equity is the problematic estimate. There are many ways we can estimate the cost of equity. For example, we can use a dividend growth model, where the cost of equity is equal to the dividend yield plus a growth rate in the dividend stream. But the dominant model used in practice is based on the capital asset pricing model. To estimate a cost of equity using the capital asset pricing model, we need the risk-free rate, the market risk premium, and the beta of the firm's common stock. Estimating the risk-free rate in the capital asset pricing model. As originally derived, the capital asset pricing model is a single period model, so the question of which interest rate best represents the risk-free rate never arises. But in practice, we evaluate multi-year cash flows and must choose between a short-term and a long-term rate. The choice is typically between a 90-day Treasury bill yield and a long-term Treasury bond. The difference between returns on a 90-day T-bill and a 10-year Treasury bond has averaged 150 basis points over the long run. So the choice of a risk-free rate can have a material effect on the cost of equity and on the weighted average cost of capital. The 90-day T-bill yield is more consistent with the capital asset pricing model as originally derived and more closely approximates the risk-free rate, as it has no interest rate risk. But when used to price multi-year assets, it requires a perhaps unrealistic assumption that short-term interest rates will not change over the life of the asset being valued. Long-term bond yields reflect expected changes in short-term interest rates. They reflect more closely the default-free holding period returns available for long-lived investments and thus more closely mirror the types of investments made by companies. Practitioners match the maturity of the risk-free rate with the economic life of the asset being valued. For most capital projects and corporate acquisitions, the yield on a U.S. Treasury bill of 10 years or more would be appropriate. We use historical market risk premiums as a proxy for the expected market risk premium. Historical averages for the market risk premium vary between about 4% and 8%. The differences are due to the time periods over which they're calculated and what data is used in the calculations. The choice of a market risk premium is a subject of considerable controversy as to its value and its method of estimation. Most corporations use a market risk premium of 6% or lower. Financial advisors and investment bankers will use a higher figure for the market risk premium. In estimating a stock's beta, we use historical price data to calculate a historical beta, which we use as a proxy for the future expected beta in the capital asset pricing model. Starting with the capital asset pricing model, let's multiply beta through the market risk premium. Let's rearrange the equation. The risk-free rate is common, and so can be factored out. Let's call the risk-free rate times 1 minus beta, let's call it alpha. And let's make this a time series, where we have the return on the common stock at time t is equal to alpha plus the return on the market at time t times beta plus an error term. and this is called the empirical market line. It's also a regression line, where the return of a firm's common stock is regressed against a market index, and the slope of the regression line is beta. The covariance between the stock's return and the return of the market index divided by the variance of the market index, and this is the historical beta for the stock. Let's look at some examples of equity betas from regressions, where the returns of a firm's stock is regressed against returns of a market index, proxying for the market portfolio. This is the regression for Dell Computers. Its regression beta is 1.62. This implies that Dell has considerably more market risk than the market as a whole. Both businesses and individuals are likely to postpone purchase of new PCs and laptops in an economic downturn, and are more likely to buy such items in an economic expansion. So Dell's revenues are probably highly sensitive to general economic conditions, and we would expect Dell to have more than average market risk, and therefore have a beta greater than 1. So the resulting beta from the regression is quite reasonable. The R-squared of this regression is the proportion of the variance of Dell's returns that can be explained by code movements with the market index. This can be interpreted as a proportion of Dell's total risk that is systematic market risk. The R-squared is 0.11, so 11% of Dell's total risk is systematic market risk, and the larger portion of Dell's total risk is diversifiable on systematic risk. As a robustness check, the regression is run again over a later period, and we get a beta of 2.02, indicating again that Dell is a high beta firm. This is the regression for General Motors. The regression beta of 0.8 and 1.0 also seems reasonable, as car sales most likely track closely with economic conditions. Likewise, the low beta for ExxonMobil is also reasonable, as gasoline and home heating oil are more or less necessities and their sales less sensitive to the business cycle. Looking at these collective results, I have 2 comments. First, there's no doubt that Dell has more market risk than Exxon, and that General Motors lies somewhere in between. This seems quite realistic. Second, only a small portion of each stock's variance can be explained by code movements with the market. Less than 30% of the total risk of these firms consists of systematic market risk. The large portion of total risk is unsystematic, unique risk. This implies that firms with large variances need not have high betas, as most of their risk can be unsystematic, unique risk. Many practitioners use beta estimates derived from historical data and published by such sources as Bloomsburg, Value Line, and Standard & Poor's. Beta estimates require a number of practical compromises, each of which may materially affect the results. Most of these compromises center on 3 things: the interval over which returns are calculated, the length of the period over which the regression is estimated, and the choice of the market index to proxy for the market portfolio. Returns can be calculated monthly, weekly, or even daily. Bloomsburg and Value Line use weekly returns. Standard & Poor's use monthly returns. Shorter intervals increase the number of observations used in the regression, which improves the statistical reliability of the regression estimates. But there are 2 disadvantages to shorter return intervals. The regression model assumes that returns are normally distributed. Returns measured over shorter intervals have distributions that deviate more from normality than returns over longer intervals. Second, returns over shorter intervals have more volatility, and that volatility may introduce significant random noise into the model. Bloomsburg, Value Line, and S&P estimate regressions over long historical periods. Bloomsburg uses 2 years, Value Line 5 years, and S&P over 5 years. Longer historical periods over which the regression model is estimated increases the number of observations being regressed, and so improves the statistical reliability of the regression estimates. But longer periods may include stale data, and betas estimated over long periods are insensitive to the introduction of new and material information. Stale data results in stale betas that do not reflect future expected betas. Betas estimated over shorter periods may be fresher betas, which reflect the latest information incorporated into stock prices. The market portfolio envisioned by the capital asset pricing model is a universal portfolio containing all the investments in the investment universe. This argues that the market index used to proxy the market portfolio should be broad-based. The broader the index, the better. Bloomsburg and S&P use the S&P 500 index, which includes the 500 largest firms traded on the New York Stock Exchange. Value Line uses the NYSE Composite Index, which includes the over 2,000 stocks traded on the exchange. Even broader are the so-called total market indexes, such as the Russell 3000 and the Wilshire 5000 index. Now, some financial analysts will estimate betas using specific industry indexes, or use a NASDAQ index when estimating betas for small firms. But these betas are not CAPM based, and they do not measure systematic market risk. What determines beta? The major part of the firm's systematic market risk is business risk. Business risk is the inherent risk of a firm that comes from the operations of its business. Business risk is a function of the cyclicity of revenues. That is, the responsiveness of the firm's revenues to the business cycle. And also on the firm's operating leverage, where operating leverage is the relative mix of fixed and variable costs that are required to produce a firm's goods and services. The secondary part of the firm's systematic market risk is financial risk. Financial risk comes from the firm's outstanding debt, in other words, by the firm's use of financial leverage. The revenues of some firms are sensitive to the business cycle, and therefore are quite cyclical. These firms do well in the expansion phase of the business cycle and do poorly in the contraction phase. Examples of cyclical firms include high-tech firms, retailers, automakers, construction firms. Firms in industries like railroads, food, utilities, household non-durable goods have revenues that are less sensitive to the business cycle. Because beta measures the sensitivity to market movements, highly cyclical firms whose performance is strongly tied to the economy will have higher betas. The generation of revenues incurs various operating costs, which are classified into fixed costs and variable costs. Fixed costs don't change as productive output changes. Examples of fixed costs are property taxes and the wages of workers under contract. Variable costs vary with the level of productive output. Variable costs include the cost of inventories of raw materials and fixed goods, sales commissions, and some labor and maintenance costs. Operating leverage is a firm's ratio of fixed costs to variable costs. High operating leverage makes a firm's operating profits more sensitive to changes in revenues, and operating leverage magnifies the effect of cyclicity on beta. Firms with high operating leverage do better in business expansions and worse in business contractions. In this graphic, we follow the firm's revenues, operating costs, and operating profits over a business cycle as the economy goes to a strong expansion and to an economic downturn. The firm's revenues are responding to the phases of the business cycle, and this reflects the cyclicity of the firm's earnings. In the first example, operating costs consist of variable costs, which vary with the productive output of the firm over the business cycle. The changes in variable costs over the business cycle is smoothing out the variability of operating profits over the cycle. Operating profits over the business cycle ranged from $36 to $48 million. In the bottom graphic, operating costs are fixed costs. Operating profits are showing more variability over the cycle as operating profits are higher in the expansion and lower in the downturn. In this example, operating profits over the business cycle range from $30 to $60 million. So operating leverage increases business risk, and this would be reflected in higher betas. The use of financial leverage by the firm affects the risk of the shareholders' equity residual claim. Shareholders have a residual claim to the firm's cash flow. Debt claims are ahead of shareholders in the line for the firm's cash flow. Shareholders are last in line. An increase in leverage places more debt claims ahead of shareholders for the firm's cash flow. As the line gets longer, the residual claim to cash flow gets riskier. Therefore, higher leverage will result in higher betas. This formula relates beta to financial leverage, and let's go through the equation. An equity beta is a beta of the stock of a levered firm. An asset beta is a beta of the assets of the firm. The asset beta can also be thought of as a beta of the stock of a non-levered firm. In fact, I like to think in terms of levered betas and unlevered betas. It's more intuitive than equity betas and asset betas. In the bracket is the effective leverage on beta. It's simply 1 plus the firm's debt-to-equity ratio adjusted for taxes. The beta of a levered firm is greater than the beta of a non-levered firm by a factor greater than 1, and that factor depends on leverage. This is called the Hamada formula. The Hamada formula can be used in practice to unlever and lever betas. We'll look at an example of using the Hamada formula to lever and unlever betas in the next topic. The stability of beta. Betas can change over time as firms change their business risk by their investments and acquisitions and change their financial risk by changing financing policy. This study placed a large sample of firms in the 10 risk classes based on beta, where 10 is the highest beta and 1 is the lowest beta. After 5 years, the betas of the firms are recalculated and the firms placed in the corresponding risk class. About 80% of the firms change their beta class after 5 years, and only half stayed within one class of their original beta class. This study indicates that betas are likely to change over a 5-year period. But a movement of 1 or 2 beta classes ranked by deciles may not represent a very large change in the firm's market risk. Other studies find that in general, betas are stable for firms that stay within their industries. But large investments and acquisitions outside their industry can significantly change the firm's overall market risk and its beta. If the firm's financial managers are maintaining an estimate of their firm's beta, the beta should be updated periodically, at least every 5 years, and after major investments and acquisitions. Now let's calculate a firm's weighted average cost of capital. Let's assume the current yield on a long-term Treasury bond is 5%. The beta of our stock is 2, and we'll use a historical market risk premium of 7%. From the capital asset pricing model, we get a cost of equity of 19%. We previously calculated a cost of debt of 8.7%, which was the valuated average of the yield of maturities of our outstanding debt issues. The market value of our equity is $700 million. And let's assume that that's the current price per share times the number of shares outstanding. The market price for our debt is $300 million. We will probably calculate that from prices on the FINRA website. So the total value of the firm, $700 million of equity plus $300 million of debt, $1 billion. And our corporate tax rate is 35%. Let's calculate the firm's weighted average cost of capital. We multiply the cost of equity by its market value weight. The value of our equity is $700 million divided by the value of the firm, $1 billion, gives us a market value weight of 0.7. We multiply the cost of debt by 1 minus the corporate tax rate to get the effective rate, and we multiply that by the market value weight for debt